AutoLine After Hours is brought to you by...
Hey, everybody. Thanks for joining us on AutoLine After Hours. Mr. Gary is here.
John, how are
As
you?
always, I'm doing well. You too?
Absolutely.
Yeah.
Mm-hmm.
So we got to let everybody know we've got Venkatesh Prasad from the Center for Automotive Research in Ann Arbor, who goes by Prasad.
That's right.
Yeah.
John.
And we got Paul Eisenstein from Headlight.news.com.
Headlight, no.
No.
Headlight.news, no .com.
Okay.
Okay.
Headlight.news.
You're going to send
There.
people a site in Arkansas.
See?
We wouldn't want that to happen, Paul.
Right.
So, but we got to give you your title because it is an important title, and then a little bit of your background to put this all into context. You're the Senior Vice President of Research and Chief Innovation Officer at the Center for Automotive Research, and before that, you had more than 26 years at Ford, and notably, you founded and led the Ford Silicon Valley Labs in Palo Alto. So that's quite a statement as we hear more and more about things coming out of Silicon Valley nowadays.
Thank you, Gary. Thank you, John, and thank you, Paul. Good to see you all here.
Good to see you.
So I mean, you're a tech guy.
Indeed.
So give us your overview of what the landscape looks now in the auto industry in terms of tech.
Fascinating, I'd say, as technology just does its job. It pushes along and forces a lot of what it enables and sometimes it destroys to change and doesn't really wait for much to happen. And so,
Prasad, though, we're seeing a real divergence here with the new EV startups, taking a totally different approach to doing cars, especially when it comes to technology versus the legacy automakers. Do you see that converging at any point? Now, what I'm thinking is software-defined vehicles, zonal compute, and that sort of thing.
yeah, I think there'd be selective convergences, and by that I mean the legacy car makers, and these are those who have to find free cash flow by selling highly profitable products, and those profits come from products that they know how to make and make well, and where there's a clear consumer demand, customer demand, and those tend to be internal combustion engine vehicles. And so they can re-silhouette those vehicles and tune them in a way in which they can sell them profitably. And so while they do that, make the free cash flow they need and put that into the growth business, they would sooner or later, and they have, and you've seen these play out in a number of forms, they need new capabilities. And to find those new capabilities, they either build or they buy or they partner. And so when they look to partner with certainly trusted, tested suppliers that they have. But then those tested and trusted suppliers also have to have new capabilities. And so that's when the startups come in. That's when people who are experimenting without the burden of having to run a legacy operation and have two operating systems, ICE and EV, can quickly adapt to the changes needed, but they don't have scale. And so they're looking for that validation. And so that's when those partnerships would come in.
I'm curious about where the industry is going versus what consumers are asking for. Now, I'm a tech person.
Yeah.
I mean, I always have boxes of new things to play with. But at the same time, I get into a lot of new cars and get either I have the Microsoft Word syndrome, where
Right.
there's tons of stuff that I either never knew I had or don't use.
Mm-hmm.
And there's many a time where I just get angry. Rivian putting controls for your mirrors and your seats and your vents on the touchscreen. And when I look at studies and when I talk to a lot of consumers, I get this mixed message. People want the technology, but they're angry at their technology. So I wonder if you can address this sort of schizophrenia, if you will, in the market.
Yeah, no, I think that dichotomy is a valid and legitimate one. I think going back to sort of the sort of framing of that whole question against the context of what technology does. Ultimately, firms have to take technologies, companies have to take technologies, and then tune it to what the market needs in the near term and midterm and long term. And then they pretty quickly discover that the design question, the meta design question, how do you take technology that's doing its job, as I said earlier on, but then in some sense harness that to get the optimal design you need for the profits you need, the customer satisfaction you need, all that to happen. And that then comes to a usability design question down below. But there's also the bigger design of how do you design the organization? How do you design what goes into making these things possible? And I think these are all still emerging now, being tested out. And so just the fact that you can't just go open the door latch, and the expectation was that if you couldn't open it, you try again, and that was like a magic number of 130 milliseconds or so. Today you press a button and you go past the 130 milliseconds. You got to wait for a click to hear. And so that's we've gotten used to it. In some sense, humans have gotten trained with these digital interfaces that we had no tolerance for when you went to an analog interface. Just try opening a latch, a mechanical one. If it doesn't open in that 130 some milliseconds, you're going to try it again, because that's what we're used to with mechanical systems. And you see this digital thing, you press a button and a light glows, and then you hear a click, right? That already has gone past your time budget for human acceptance. And so there's a number of user interface questions that are going to come up at the individual sort of widget level, but also at the system level.
Do you see some automakers pulling back? I hear this anecdotally, and I've seen a few things. Hyundai has put more emphasis on having secondary controls, for example, for climate and for audio, as opposed to keeping everything just on the touchscreen.
Yeah, no, I think there was certainly a rush to put everything on the touchscreen because it seemed that there was a good way to reduce costs, reduce complexity. But there's a recognition that at the end of the day, you want to go from A to B, and you want to come back safely, and you want to, also perhaps allow that to happen without necessarily being on a screen yet another time, because you're so screen inundated from the time one wakes up to when we go to sleep. And so this, you want that little bit, perhaps that'll come back and say, I don't want that. I just want to drive without that screen.
So Prasad, John mentioned startup EV companies are appearing. You mentioned the legacy companies that have the cash flow from ICE.
Yeah.
Okay, so it seems that these are two entirely different cultures, yet both of these cultures are competing in the same marketplace. So how do either of these companies perform in a way that will allow technological advances such as autonomous driving or more EVs?
Yeah, no, I think it's through staged and carefully orchestrated partnerships, a series of partnerships where the startups can offer a lot, with the right kind of support, can offer a lot of innovation designs, or innovative designs, but also production innovations, pathways. But the large manufacturers, the producers, have that scale. They have the ability to take things to scale, and be able to then industrialize it, if you will. And I think that's where that the complementary capabilities lie.
So you think it's complementary versus?
I think there'll be a bit of both. I mean, clearly you've seen Tesla take its form and grow, and BYD go to scale, and they haven't been dependent on a legacy car maker. But you have others who are coming to the marketplace now, and one can see that they have the need for scale, and it's not easy. And the legacy car makers need to move quickly and need to move with the ability to both balance their legacy portfolio and quickly move when they have the opportunity to do so with respect to the EV piece. And so yes, they have in-house designs, but there's always the capability that takes you to the next level. that often you find only outside
Mhm.
because it's you might have it in-house, but you might see it proven just enough on the outside, whereas the in-house version may not have had the chance to get that proof, that early proof that you need in terms of design iterations.
Jerry, I know you had some info from some recent studies from the Center for Automotive Research that had triggered some questions in your mind.
Well, okay, so you guys most recently did the study of tariffs.
Yeah.
And now we got reporting today that there's closer to a deal with the EU, which may bring it down to 15% from the 25% it did before. But so when you guys did this study, and our friend Edgar Fowler, who's on the show, who was involved
Also from CAR, right?
Also from CAR was involved. So you were saying that it would be an increased cost of $107.7 billion to all U.S. automakers, an increased cost of $41.9 billion to the D3 automakers, and an impacted D3 production volume of 6.8 million vehicles. So this is just costs of producing vehicles in the United States. And talk to us a little bit about that. I mean, and then I want to mention you guys used as one of your data points the American Automobile Labeling Act. And I was shocked to see some of the numbers in terms of the Detroit 3 and what their domestic content is.
Right. So I think on the roughly $107.7 billion number, I think the best way to look at this is to look at how that cost gets distributed. So there's two parts: what the sources of what the line items are that result in that cost, and that was based on the assumption that there's a uniform 25% tariff on all trading partners with no relief for any existing agreement. And then you look at that total amount and you say, well, who are all the players here that at the end of the day need to come together for this industry to be viable and for consumers to benefit? And that's the suppliers who supply components and subsystems to the OEMs, and then the finished products get distributed, and you have the dealers who then take it to the end user. And so no one explicitly or otherwise, until they have to, wants to speak about the end user, the consumer, the customer, and say, okay, we want to protect them. So then you essentially get to dividing this number by not by three, but spread across three different entities: the suppliers, the OEMs, and distributors. And then so that's how that dynamic works. And so with the latest EU-US agreement, you turn the knob slightly differently. You go through the math again, but you're going to still come up with a pretty large amount, because it's not as if the US exports a whole lot to Europe, or Europe exports a whole lot to the US, where there's going to be this big shift in these numbers.
Mm-hmm.
And so I think that's where we are today.
Yeah, so to the point of suppliers to the industry. So I already quizzed John on this, so I'll throw this one to you, Paul. So Ford, what vehicle has the most domestic content as measured by the American Automobile Labeling Act? What vehicle is it, and what is the percentage of domestic content?
Oh, I thought I remembered the Tesla.
No, just we're asking about Ford now, so we're just looking at
Ford,
D3.
I'm sorry.
So just
my instinct would be to say the Mustang, but I'm probably wrong.
You probably are.
Yeah.
So
if I were to look at it, I don't know.
Yeah, it's a surprise to me. It's the Ford Ranger pickup truck, 46% domestic content.
That's all.
That's all.
And by the way, by domestic, you are talking absolutely U.S., not North American.
I think it's USMCA. I believe is
Okay.
that's in those numbers, right?
Only 46%.
46%.
If I remember this year,
That was Cars.com did the study.
and
American
Ford
made.
dropped out of the top 20, if I remember correctly.
But then, okay, so let's move on to General Motors. So what vehicle has the most domestic content according to the AALA in 2025?
Damn, I wish I remembered. I wrote
This one is just flabbergasting. It's the Bright Drop. Remember the
Yes.
65%,
Which is, of course, Canadian assembled.
which goes back to the point of
Yeah.
USMCA. So it's now if we were to take that out of this, okay, so now we'll say what vehicle, consumer vehicle, General Motors product.
Boy, I'm going to fail this. I'm not even going to get a D in this. I don't know.
Colorado Canyon, 49%.
So the small pickups.
Yes.
All right, so here we'll give you the third one, and you may get this right because you now have a clue. Stellantis.
Gladiator?
Bingo, you're right. See?
Oh, good. I got a D plus, right?
And it shockingly is 74% domestic content.
74.
Yeah.
And Stellantis as a whole is relatively low, if I remember, on domestic content.
Yeah, it's like the Dodge 400 and 500E. They're the only ones that I found have 0%.
Which one?
The Hornet and the
Oh, yeah, of
500E
course.
have 0.
Yeah.
But what's surprising to me was the Nautilus, which is assembled in China, has 5% domestic content.
I'd love to know what that 5% is.
Mats.
Right.
So Prasad,
Probably not
so
that.
I mean, to get back to your point, though, I mean, so these percentages, so if we go to Colorado Canyon, this means 51% is non-domestic content. So this would be 51% that tariff is being paid on.
Yeah, tariffs are being paid on, and then you got to go through the materials and say, is this already covered by something else? Is it covered by a bilateral agreement? Is it a material that now perhaps can sit somewhere else, get processed, and then show up and then get charged less because it's not the the original form in which it was imported that's now being imported in physical or in market terms. So it could be sitting in a economic zone where it gets pre-assembled and sold. So there's all kinds of nuances that come into play here.
Well, we just saw more tariffs get dumped on a bunch of steel and aluminum componentry.
Exactly, to that point. Exactly.
So that, for example, and it's very specific. It was like mufflers, exhaust systems, clutches, that sort of thing. You pay a 50% tax on any of the steel or aluminum that's in the component, and then you pay the tariff on the component
Finished product.
itself.
Yeah.
So it's a double dip.
It's a double whammy, right?
Similar to what's going to happen with copper soon, from what he's been saying.
Yeah, well, again, they're looking at very specific. It's not a blanket, tariff on the 50% that's cumulative. It's on very specific products, and it also hits any kind of commercial vehicle, just about, with an engine greater than 1,000 cc's. So that's everything, right?
Right.
And then a lot of agricultural stuff, especially tractors.
Which is great for American farmers.
Which goes back to the earlier conversation we were having about
having to pay the $1 million combine.
Yeah.
So John and I were talking about this before the show, and I know that Carr looks into plants and factories and what's going on in that space. So as we look at these tariffs, as we look at the possibility of reshoring, I mean, what is your sense of how long it would take for that to meaningfully be producing in the U.S. so these tariffs would be avoided?
I think just to the points made just a few minutes ago about how much content is not either within the USMCA region or purely domestic U.S. made, the supply chains still go back and forth outside. So that's one piece to keep in mind. And the other piece is, so you reshore, but you're still dependent on the ins and outs of how trade happens and how freight logistics happen. And then the second piece is when you come back, you never come back the way something might have left. You come back with increased levels of automation. You come back with the need to be compatible now with new markets that you have to be competing in, either directly at the product level, or if you're a supplier, you have to be ready to be able to supply to China, supply to Europe, and to the US. And so that brings in a whole lot of dynamics that then say some subsystems can come back in the course of a year. If you're talking of total vehicle return, that really depends on where a plant was going to be ready for receiving this new program anyway. or you'd come so close to making a decision and you said it was going to be either here or in Mexico, and there was some advantage of being in Mexico, but there's probably a slight cost differential working against us and keeping a plant here in the U.S., keeping the program assigned to a plant in the U.S., but now that's gone away, and therefore you bring it back here. So otherwise, it's really hard.
Let me ask Gary's question, but in a slightly different way. You know, at some point, the tariffs, the onshoring because of tariffs is going to level out.
Yeah.
They're going to figure out what the appropriate level is. The market will figure that out. How long do you think that's going to take?
That can go through a couple of iterations. You know, it has to. There's always a lagging impact of almost everything we speak about in the world of tariffs, because it takes a while for the stock to deplete, and that you buy the next wave of components, and then you go through the design
What's your sense?
changes.
Would it be 5 years? Would it be 8 years? Would it be?
No, I'd say it'll be 4 or 5 years. That's how long it takes at the very least. Yeah.
I wonder about this. We seem to be taking this position, which I'll be honest, I think the administration, it just doesn't have a clue about how particularly the auto industry works and why globalization is important. And it's not just because in Vietnam they have low wages, because we know that wages are not as much as many people believe in the total cost of vehicles, for example. So when we look at globalization, a lot of it has to do with we have huge number of vehicles compared to where we were 40, 50 years ago. We might have had a handful of models from a particular brand. Now we have an endless supply of nameplates and trims, and the volumes are so much lower. And the way that you allow for that is by finding a place to produce vehicles that go worldwide. So we get worldwide volume. Can we really keep the system that we have, where we have huge choice in models and nameplates, if what we have to do is essentially build everything here?
No, it's going to be very hard, and especially because the goal itself of getting to electrified propulsion hasn't changed. The goal post might have moved on a little further, and so what that really means is that it's the moats that existed before to creating products and defending yourself against competition have been reduced or gone away to a large extent, and so it's going to be very tempting, and you're seeing this in terms of entry into the auto space by people who were not there before. So you have people who are battery manufacturers are now making cars and doing a great job. People who are tech manufacturers experimenting with making cars, and so you're going to see a lot of options. And so you might find this world where you have a lot of brands make, some of which you haven't heard of at all, and a lot of different options. At the end of the day, this has to consolidate because you do need volumes, but the volumes could come at the subsystem and components level, and final assembly being relatively simplified, especially as you are seeing a lot of these announcements these days about simplifying the assembly process and making them more efficient. You might almost do contract manufacturing on those. So you might have different pathways now.
But I still don't know how you can bring things back. You have a lot.
No,
It wasn't that long ago where if you didn't sell 100,000 vehicles
Right.
of a particular
right.
model,
No, I understand. Yeah.
you couldn't make money. And now we have a lot of 5, 8, 10, 15,000 unit models. And that is primarily because we find a place, whether it's in the US or somewhere else, where we're making up the additional volume through exports or through sharing top hats and so on.
That's right. Yeah.
And it would seem to me that if we're going to bring a lot of manufacturing back in, you're going to have fewer models and perhaps fewer manufacturers too. I don't see how you can do it otherwise.
Right. Fewer, I'd say you certainly need enough capacity, enough utilization of the capital investments you make, to your point. So there's going to be consolidation in many different ways.
And less choice for consumers, I would think.
Consumers might get choices in a different way. And maybe that's where the consumer mindset itself is shifting. So they may not necessarily want the physicality associated with choices, but they might want the feature choices, and that might come because you can use old hardware in a way in which, I don't mean old hardware, but I mean you can use hardware that's ready for reprogrammability and ways by which it can be mixed before that you couldn't do earlier on. So that level of I think flexibility and newness people might come to expect, as opposed to seeing a new model year every year, right? So I think that's been discussed quite a bit.
So last year, Carr did a study almost a year ago today, almost. It was the 24th. It came out. Affordability, the $25,000 electric vehicle, and you guys used $25,000 as saying, okay, this is a low price. It was just, not how you do it. But, you were talking earlier about suppliers, and this whole discussion brings to mind, this is a quote from that study, and I want you to comment on it. For suppliers, and particularly smaller and lower tier suppliers, large and long-term orders are key for amortization of investments. Without this assurance, suppliers view heightened risk in the EV transition as automakers adapt investment plans to match market conditions. Okay, that was just talking about trying to capacitize for EVs. Now the tariffs are on top of that, because this was written before tariffs were anything. Yeah. So what do these suppliers do? How do these suppliers react to A, increased costs, and B, the investments that are necessary to bring us to more EVs?
Yeah, I think one thing they might do in the very short term is to go back to their customers to look for extensions or look for business in terms of components or subsystems that they were supplying that were needed for ICE or needed for plugins or needed now for extended range vehicles. While they still have to pay their monthly dues on the new tool sitting there that was designed to package cells into modules and package modules into batteries. And so they had to figure out a way by which they can get some revenue and either defer payments or reduce payments on these other tools that they have. But that's the reality that they're facing. So they went ahead and bought these tools that were contingent on these orders that were coming in, or near, certainty of orders coming in to build electric vehicles. But since that went away, that big order likely either got muted or put on hold for a while or went away altogether. They have to now look for alternative ways by which they can get revenue. And so these are all ways by which they have to sort of go back and say, can I get back into that, fuel exhaust pipe business? Because, I did this for you for 5 years or 10 years and did well. And so can we go back to that?
Yeah. Prakash, we're at the bottom half of the show right now. We're going to have to wrap this segment up, but I really want to thank you for coming on the show.
Thank you very much.
Some very good insights there.
Thank you. Appreciate it.
We should give a plug to you'll be there.
So yes, the Management Briefing Center, for anybody who's in Detroit, the conference is going to be at the Michigan Central train station in downtown Detroit. And
September 15th evening, there's a reception, and 16th and 17th, we have action-packed discussions. It's really exciting in so many different ways. As we just discussed, there are so many topics that are likely to be revisited, and some might sound familiar, but might have a completely new dynamic associated with them. Others will be all new. And so we are really excited about that event and hosting it for the first time now. This is going to be our 60th anniversary of MBS.
Right.
And that's going to happen for the first time, not in Traverse City, but it's going to be happening here in Michigan Central, right in Detroit. So welcome.
Yeah. And a lot of people in the industry know about the management briefing seminars.
That's
so
right.
Yeah, I'm glad you brought that up, Gary.
And and even if they're not in Detroit, I'm looking at this lineup, and they might want to consider flying into Detroit.
Who do you see as the star of the show, or the stars?
Well, there's this guy who's sitting next to me.
Well, he's always the star.
Gil Pratt from Toyota is going to be there.
Yep. I'm gonna completely just
anyway,
show him in
people can go online and find the full lineup, the agenda.
Yeah, it's going to be a great conference.
Yeah.
Thank you, gentlemen.
Thanks again.
Pleasure spending some time with you.
We're going to take a quick break right now. We're going to be coming back and talking about the latest news of the week in the automotive industry.
We help businesses respond decisively to their most critical challenges, from urgent performance improvement to enterprise-wide transformation. We work across the full value chain, in automotive and in industrials, helping clients navigate disruption, drive innovation, and unlock sustainable growth. Alex Partners, when it really matters.
All right, we're back talking about what's going on in this auto industry. And one thing, Gary, that I see in Paul too is, man, the situation is darkening for EV startups. You've got the $7,500 credit that's going to go away. Even perhaps more importantly, all the ZEV credit money, which was in Tesla's case billions of dollars, going away.
And Rivian
and Rivian and Lucid,
and
Lucid put out a statement saying, "Wait a minute, this was a significant amount of income for us. The future doesn't look too bright, at least short term."
So, I mean, this gets back to what Prasad was talking about in terms of, okay, how do you make your investments when you have this uncertainty? Now, there are the certainties that you just identified, but there's the other uncertainty of the market. And Paul, I know that you pay very close attention to the consumer aspect of this. I mean, and you look at numbers of projections that people are doing now. I mean, it'll be 8% maybe this year for
you just saw Auto Pacific. Ed Kim over at Auto Pacific put out a release this week on a study, and the numbers were shocking. I actually wrote a story on Headlight.news combining that with something that Bloomberg came up with. First, Auto Pacific. They are basically having the market share projections through 2029 that they had made less than a year ago.
Which was
the election.
What were they at then?
This year was supposed to go to, I think, 11%, and they're now saying it'll be flat at 8% compared to last year. Excuse me, and I can't remember the exact number, but basically 2029 is only going up to like 12% instead of 25%.
That was the big one. That was the 50% drop. They were saying
more. It's slightly more than 50%.
It's like 51
less than the numbers they had, and they were actually on the conservative side to begin with. Now, add to the fact that we are seeing sales level, and they use the word flatten, but really are going to slightly dip after September 30th. And what you have is automakers, including Lucid, that are trying to make up for the loss of the $7,500 federal tax credit, on top of needing to motivate beyond that. We've seen some big deals. There are some EVs right now that are being sold, or should say leased, for as little as $100 a month. The Prologue from Honda, which was actually not doing badly, you can get in some parts of the country a Prologue, which is what, a $48,000 EV, list price MSRP, for $200 a month. I mean, that's insane. That's a 48-month lease plus a little bit of down payment, but that's $200 a month. Doesn't even cover the basic materials, never mind all the production process.
So the question becomes, do the entrants like Rivian, like Lucid, do they survive? Can they survive?
It's hard to see how. I mean, what Lucid is saying is it's going to pay the $7,500 out of its own pocket. This is a company that lost $1.5 billion just in the first 6 months of the year.
They have one thing going for it: Saudi money. And the Saudis seem intent on positioning themselves for what they still believe will be an eventual move away from oil. And that's
but how long can you afford to lose that kind of money?
How long can the Saudis afford to lose that much money? How many more years before the sun explodes?
Okay, but Paul, this is the thing that has always astonished me when we're talking about, companies or organizations losing billions and billions and billions of dollars. Okay, so the question, if I were them and I was saying, wow, that investment isn't paying off very well, maybe I had to put my money in something else.
Exactly.
Right?
They don't want to lose money.
No one wants
This is an investment for
no,
them,
no,
right?
I get it, and it's really funny because we've seen a couple of the losers in the EV startup segment. Faraday Future, who in the last few months have been like, we're coming back, we're going to make it. Faraday was at the Pebble Beach Concord just a little over a week ago, showing off some stuff. So there will be a few that there's no question are going to go away. I think there may be a couple of startups that somehow or another are going to squeak through. They're going to maybe push through, and some folks are going to put money in them to keep them alive, hoping that as we move through the final years of the Trump administration, that we may see some positive momentum.
But okay, what happens even to the Detroit Three in terms of their investments in EVs? Do they begin to pull that back?
They already have.
They already have.
I mean, but will this be like more serious than they are now? Because you're saying the Auto Pacific number shows that the market is not going to be
See,
what
I'm not 100% convinced that the Auto Pacific numbers, the revised numbers, are going to be true. EVs are such an unknown even now. Ford could be changing the game dramatically with the universal EV project that they have. What happens if we start to have a bunch of $30,000 EVs? And we just saw some pricing on Leaf that brings it down well below $30,000. And we start to get range. And there was another study that just came out.
I don't think it was well below.
Well, it was a few thousand below. But
do you have that, Sean? What was the Leaf MSRP?
I thought it was like
$29,999, and then you throw in destination charges.
I thought I just saw a lower number for the base. But anyway, we're also addressing some of the other issues. There was another study that just came out that said, despite the Trump administration initially backing off on spending the money for a national EV network that Biden had put out, the $5 billion, that the pace of growth of the EV network is faster than people expected. And there was a significant improvement in charging, that the problem with, what do they call it, non-start charging events, which you plug in and it doesn't work. That number has started to drastically fall. So there's so many things that could actually help the EV market, even without the 7,500. And you have seen some people that said eventually, even Musk had said this, eventually we need to get out of the $7,500 subsidy. Plus, a lot of vehicles weren't being subsidized except in lease. So I'm not as completely convinced that EVs are in a near-death spiral as some folks are.
So John, what did you mention oil is going for?
Well, the Energy Information Agency, which is a U.S. agency that tracks oil production prices and all that, the numbers are astonishing. I think a year ago, this time frame, oil was trading at $81 a barrel. I think right now it's at $67 a barrel, and the EIA says it's going to drop down to 50 and maybe below 50 next year.
So what's the argument for not building more internal combustion engines?
Look, gasoline prices also by the EIA will be consistently below $3 a gallon nationwide next year. So, I mean, it's all the more impetus for a lot of consumers to go out and buy an ICE vehicle.
Mm-hmm. Well, now that also raises the question, ICE or hybrid? Because even with what's happening, there is a definite push. There's no question, as far as I'm concerned, that hybrid electric vehicles continue to take off. Consumers are liking that. Automakers have found a really smart way to get hybrids to work. I get
Some
great,
of them have.
Well, but more and more,
there's maybe 3 that are good at it.
Right, but
more and more are starting to say, hey, we'll give you great mileage and better performance, and we're not going to charge you all that much more.
Right, but let's not lose sight of the fact that when we talk about hybrids, it still has an internal combustion engine.
That's right.
Yes.
So you're still building engines. You're still using
agreed.
gasoline. I mean,
right.
So again, going back to Prasad talking about, okay, you need scale, you need volume. Where's the volume and the scale going to be? It's going to be making engines and transmissions.
In the short term, for sure.
And I'm wondering how short this short term is. I mean, it may be longer than we think.
Look, this is lighting a fire under automakers to really figure out how are they going to take out cost and come out with more compelling EVs. We saw Ford's announcement last week. The rest of the legacies have got to be working on the same thing.
Yeah. I'm sorry, John, but one of the things that I'm intrigued by, and it's certainly something that's happened within our group, if you will, of journalists. It wasn't very long ago that people were starting to suddenly beat up on Akio Toyoda, the man who very often was seen as the visionary in the industry, but also was very much against a pure, unadulterated switch to EVs. He was a very big proponent of multi-energy. And now we're seeing, first of all, some manufacturers go back to that approach. And all of a sudden, the companies that were using that, Stellantis with the Stella Large platform that can handle any of 6 different types of powertrains, from pure ICE to pure EV, they're all of a sudden looking like they're brilliant.
Yeah, well, Akio is still excoriated by the environmental community. They still accuse him of dragging his feet on electric cars.
Yeah.
But Toyota got it right. For right now, hybrids really work. People love the idea of getting up to 40 miles to the gallon, and it's why the sales of them are going gangbusters. But the only strong players in the U.S. market really are Toyota, Honda, and Ford. The rest of them are scrambling to catch up.
No. Hyundai Kia as well. If you look at the numbers,
their numbers are rising.
I came here directly from driving the new Kia Sportage HEV, which is, I can't go very far in it. It's impressive when you see the reviews. The numbers are good, the performance is good, and if anything, they have gone from 15% HEV just a couple years ago to 25%, and they're aiming much higher as they get through some production bottlenecks. So you're going to see the Koreans become significant players. I believe Kia right now is second only to Toyota in the number of HEV models that they have on the market.
Offerings.
Yeah.
They're offerings to the market.
Yes.
So okay, given all this goodness of the HEV, then what's the argument for the EV?
Right now, it's a harder one to make, but not impossible.
I mean, I was driving a Honda Civic hybrid sedan, and not even trying, got 59 miles per gallon.
Yeah.
It was shocking.
Ask people who own them, and I have one, and I'd still go to an EV.
It's a better driving experience.
It's a better driving experience. The torque is wonderful. The control is wonderful. I like one pedal driving. I don't see myself going back unless I get a narrow niche of products. I'd love to own a Corvette, but now I have a hybrid version of that, right? Maybe under certain circumstances, I might want a gas, more likely hybrid model if I was doing a lot of extended driving or heavy towing. But I don't see myself going back to a gas model.
Paul, I say this in the nicest, most respectful way. You're an outlier.
I know more and more people that love EVs when they get in them.
Look, the stats show once people have an electric, they pretty much stay with it.
Yeah.
I want to say the retention rate is somewhere around 75%. So a quarter of them do go away, but the vast majority stick with electric.
And often they go to an electrified vehicle as opposed to an all-electric vehicle. And that may be because they're outliers in terms of where they live or where their energy costs are, or because of their use case.
Yeah, I personally don't like the way that hybrids drive. If you mentioned the Corvette hybrid, that's for performance. That's not even really for fuel efficiency.
No.
I just don't like the way they drive. I'm sorry.
If you're the middle American taking the kids to the pool,
then it's brilliant. They're not going to care. That's right.
And this explains why there is still the greater number of people who are buying just plain old cars. And
middle America will be perfectly satisfied with a hybrid driving experience until they experience driving an electric car. And they're not going to be able to put their finger on it exactly why. They're just going to go, man, this just drives better.
Exactly. That's one of the reasons why I think EVs may hold on better. When you start having some of the negatives beyond price, become minimized. More charging stations, fewer charging failures, for a great example. And you and I, or whoever owns one, start saying, I don't have any problems. I just drove to Traverse City. I didn't have an issue.
Yeah.
Or even better, I get the universal EV, and what are you talking about? My vehicle costs less than the gas model.
The thing
Why-
to keep an eye on right now, I think, is sales of used EVs.
Mhm.
You know, how many secondary buyers are there really out there in the market that are going to buy them? Right now, used EV sales on a percentage basis are growing faster than new ones. But I think that's also people rushing into the market to get the $4,000 rebate that
Yeah.
they can on that. But that's the thing. Once the rebate goes away and we let the market settle down for a few months, I'm going to be curious how well used ones sell.
Okay, so that's a perfect segue to sort of bring us away from talking about EVs.
Okay, good.
Okay.
What?
Is the announcement by Hertz that its used cars will now be available on Amazon Autos.
Right.
Now, it's going to initially be in Dallas, Houston, LA, and Seattle, and they have plans to expand Hertz car sales.
And Hyundai's putting its used inventory on.
Hyundai's putting its new
New
inventory.
inventory.
Oh, new inventory.
Yeah, they announced that at LA last year.
Yeah, but I
because
mean, it's just, yeah. But
it is used as well, because I went to the website to look and they were all used Hyundai's on there.
okay, so what happens to dealerships if Amazon begins selling these Hertz
Amazon
vehicles?
is selling inventory that dealers are posting. So, you know, with franchise laws being what they are, Amazon can present the inventory, and it's probably going to take a cut of whatever sale happens, but you're actually going through a dealer to get the car.
Okay, so in the case of Hertz, you go to Amazon Autos,
Right.
They complete their purchase online,
Correct.
and then they pick up their vehicle at a Hertz
So
car
franchise
sales
laws-
location.
Didn't the Hertz vehicles just used to go to auction houses?
Right.
Wouldn't
No,
it hurt
no,
that
no.
more than the dealers?
No, there's dealers.
They
There's
have
one
their
on
own
Tel- there's one on
outlets to sell
Telegraph.
them. Remember, this is how rental companies make their money. They don't make their money renting cars. They make their money selling cars. And the rental fees pay for all the depreciation and the maintenance. But when used cars, franchise laws don't apply to used cars,
Mhm.
essentially.
But I mean, so I've got to believe that this is going to have a deleterious effect on, all of those car dealers that are 100 yards from where we're sitting right now, because they have used lots, and suddenly maybe they're not going to be selling quite as many vehicles as they previously had because of the frictionless buying experience that Amazon offers.
Well, if I were a dealer, I'd run to Amazon and put my inventory on there. And so, instead of just having people drive by my dealership and maybe driving in, or maybe they get online to go just to my dealer to search. No, they get onto Amazon. Boom, my inventory's there.
So does it lower cost? I mean, we always hear an argument against using the franchise dealer system is the cost it adds. Now you're adding another layer. You have the used car dealer. That doesn't go away, and they're going through Amazon. It's going to take a cut. So is Amazon going to make it efficient enough that the whole process of selling used vehicles can absorb whatever Amazon's going to charge?
Look, you got to sell your inventory, right? How do you do that? You do it with advertising. This is just another form of advertising, putting your inventory on a website that gets mega traffic, way more than your dealership traffic site is going to have. And so the real cost of dealerships is not that they cost a whole lot more to sell a car. It's that they've got acres of cars parked on their lots, waiting for somebody to show up, cars that the dealer has had to buy from the factory. They're floor planning it. That's where all the cost comes from. So the direct sales model was the ideal was before the car even comes off the assembly line, you know exactly the customer it's going to. But, as Tesla has scaled up, it's got all kinds of inventory. They're dropping the prices on their inventory right now. They've got, right now, you can lease CPO Teslas funded by, they're trying to get rid of inventory. So even their direct sales model is not as direct as it used to be.
Paul, what's your sense of all this roiling that's going on with Tesla? How's it going to come out at the end?
If you asked me this 2 months ago, when Elon was in the news every day and was really getting hated by both sides. He had ticked off all the traditionally liberal, green-minded buyers that supported Tesla. And then he got into a tiff with Trump and was ticking off the other side. I would have thought that Tesla would be in much worse shape than it is. The reality is that their sales in California, the most liberal market, the most traditionally liberal, green-minded market, are down less than 20%. And then if you look in Europe, where Musk himself got people really ticked off because he stuck his nose into some politics, and in some ways it made it even uglier, supporting an essentially neo-Nazi party in Germany, and then taking on unions and workers in Scandinavia, where worker rights are just sacrosanct. You actually saw Norway rose, Britain rose in sales. So it's
not Britain. Norway did.
Britain did 1 month as well.
I
thought maybe I'm wrong, John.
No, it's Norway, and they're up substantially.
Yeah, there was a period where Britain was actually looking better than the rest.
Not right now.
Oh, we'll catch up. We'll catch up on that later. But the bottom line is, I think that Tesla hasn't taken the big hit that I thought they would, except, of course, with the symbol, the vehicle that represents everything that people dislike about Musk, the Cybertruck. And that's, unless they find another way, it's DOA. I mean, nobody wants it. And the people who want it are the ones who are in your face and say, ha ha, I bought one anyway. That's not a great recipe for a business.
Well, remember, I'm just thinking back to when we had Warren Brown on the show a year, or maybe even 2 years ago, maybe 3 years. And he said, look.
He's been on here since then.
He's been on there since
people realize,
then, right. But he used to do forecasting for General Motors, production and sales forecasting. And he said 2 or 3 years ago, look, none of them are going to sell more than 40,000 of these electric pickups a year. Not the full-size ones. The market's just not there for it. So, the Cybertruck's a total flop. It's an engineering and technological masterpiece.
I'll disagree on some angles, but okay.
It's angles.
But going back to the whole dealer thing, another couple of things that broke this week is Jaguar dealers bailing from the brand. They're looking at the brand going all electric. They're looking at Jaguar doubling the price of the cars they want to sell. It's got disaster written all over it.
Can you see anything that tells you that Jaguar is on a course for survival?
No.
You asked before about startups. In a way, Jaguar is a startup with a once legendary name.
Yeah, right. And no, look, as I said when they first showed their wild new designs, bully for them for being so bold and breaking the mold and going out there. But by the same time, they've left all their legacy behind. All the legacy that Jaguar owners have loved and cherished, that's gone. And now dealers are looking at it and going, you know what? I'll keep my Land Rover dealership, but I'm dropping my Jaguar franchise. And then the other thing that we saw too is VinFast. So Gary, what do you think? VinFast is dropping the direct sales model and going with dealers.
Well, again, this was a situation where that company has a lot on its plate, trying to bring a new name, a new product to, for them, a new market, and to try to sell, direct. I think that's just too much for them to deal with, and so they've cut some deals. I think the first one's a dealership in San Diego.
Just opened their first,
in San Diego.
No, they had showrooms that they were going to open, many of which were just sitting there and never did anything. VinFast, the best thing that can happen for them is that nobody remembers how bad the first product was.
Mm-hmm.
I was stunned. I went over to Vietnam twice. Once when they first launched the company and were making versions of the BMW X5. And then when they were just getting ready to launch the VinFast VF8 and 9. And a lot of us, many of whom you've had on the show, were just stunned with how faulty it was and saying, guys, this may be good. You've got the bones, but you need a couple of years. and they just stuck with the name VinFast and rushed it to market. And I have not been in any updated versions so far, so I don't know if they've improved the product at all.
So this gets back to the earlier point you were making about the entrants that are into the EV market. Now, we would say compared to VinFast that Rivian and Lucid are established companies. Okay. Does that company even have a possibility?
It's selling well in parts of Asia.
Yeah, but I don't see it
No, I mean,
surviving in
here.
the U.S. market.
Yeah.
No, I don't. Their business plan more than likely was predicated on getting a bunch of ZEV credits that they could sell as well. You know, that's been Tesla blazed the way for all the other startups. Get a bunch of money, get all these car companies to pay for your ZEV credits. Well, in the United States, at least, that money's going to evaporate. In fact, it already has. You know, the government has stopped even filling out the paperwork or asking for the paperwork for all that.
That is being challenged in court, if I recall.
Yeah.
And I'm not sure. I don't know enough about the legal precedent, whether or not the Trump administration may be forced to start going at it again.
I think it's done. I don't see it coming back either. I mean, you know, look, I'm all for cleaning up the air and improving the environment, but in my opinion, too much has been placed on the automotive industry. Remember, light vehicles in the United States account for 14% of all greenhouse gases, all 14%. And I don't see any other industry at all being regulated or fined anywhere close to what the auto industry is. And so even, you know, I'm all in favor of EVs. Everybody who watches the show know I'm an EV proponent, but, you know, they cut, in a life cycle basis, the emissions of compared to a gasoline car in half. So even if you got everybody to drive an EV, you'd take 14% of greenhouse gases from the total down to 7%. I mean, it doesn't solve the problem. And so I think that the industry has been unfairly targeted for all these improvements. And I even with a Democrat administration coming in the future, I just don't see those levels of fines coming back.
All right, so I've got one, because this is the year of autonomy.
Yes,
this is
2025, brother.
This is for you. So I read that Neuro, which is a company that makes automated driving technology and has deals with companies like Kroger to deliver autonomous groceries and so on. It is now valued at $6 billion following the closing of a Series E funding round. So I was thinking to myself, you know, $6 billion, what does $6 billion mean?
Probably more than Nissan's worth.
Well, that was exactly so. As of now, Nissan is valued at $8.25 billion to $8.39 billion in market.
Yeah, give it a week or two, and
But
that'll be lower.
okay, how is this possible?
That what, Nissan so low and Neuro so high?
Or vice versa?
Because look, the market, Wall Street rewards companies that have projected future growth.
Yeah. What would Tesla? I didn't look today. Yesterday it was about $330 per share.
Yeah, so it's
If you
over
took-
$1 trillion.
Right. If you took the autonomous forecasts that Musk has come up with, whether full self-driving or fake self-driving, if you prefer, and robo-taxi and everything. If you took that out, if tomorrow for some reason he said, nope, we can't do it, how far would their price go?
Well, you know, they're trading at, 170 times earnings or something crazy
Something
like
crazy.
that. It would drop down to legacy levels. You know, what's GM trading at now? I don't know off the top of my head. I want to say 8 times earnings, 6 to 8 times earnings.
Mm-hmm.
So Tesla would drop down to that. But it hasn't dropped down to that because everybody's looking at the robo-taxis. They're looking at the Optimus robot. They're looking at the AI stuff that Tesla's doing. And they're going, this company's going to continue to grow. Now, if none of that growth materializes, then it will go down to legacy levels of trade.
They really have, maybe 2 to 3 years to prove that all these alternatives.
Yeah, that's what I would give them, right?
Yeah.
But look, you know, the AI thing is huge. In fact, that was another big story that just broke today. I think the Wall Street Journal had it, of General Motors going out in poaching AI experts from all the tech companies in Silicon Valley, Meta, Amazon. And
See, you got to wonder though, John, that, okay, Meta is paying like mega dollars
Right.
for AI
right.
engineers.
So what's GM paying?
That's what's GM paying.
They got to be paying that, because why would you otherwise leave this great paying job to go work for GM?
So is this how they're getting back into, almost getting back into the cruise automation system?
Well, yes. The shorthand answer is yes, but they're looking at AI for a whole bunch of stuff. They're looking at engineering, they're looking at finance, they're looking at HR, they're looking at autonomy and other
Factory
things.
layouts.
Right. And so it's very interesting that top AI talent in the Valley is going, yeah, I want to go work for a legacy automaker named General Motors. And it's the same with Ford Skunk Works in California. And I'd love to know, Gary, what the hell they're paying those people, because the only way you're going to get them, I mean, if you're a top level programmer, you get $1 million a year. That's what you get. Whereas, your engineers back here in Detroit are maybe getting a couple of $100,000, depending on where they are with their bonus and stuff.
How do
like
those
that.
guys feel?
They probably thinking, I wish I had learned coding.
Probably some of them are going back for it.
Yeah, they probably are. But here's the other danger. Now, remember when we had the head of M-City on the show here?
Yeah.
What was it, beginning of the year, late last year? M-City is the mobility / autonomy test track at the University of Michigan. He told us that his engineers have not been writing software code for autonomous vehicles for 2 years because AI is writing it all for them.
So you hire the AI engineers and you're good to go.
That's right. Well, anyway, I'm out of topics. You too? It's a good time to wrap
All
up.
right.
So unless you got a really good one.
No, we'll let it go. We'll let
Okay.
it go.
Really good.
Well, I will ask you one more thing. You just brought up something very important, and I know you touched on it a little bit with Ford and the Universal. One of the things I thought was really downplayed until a couple of us started hammering the question: how much is employment really going to go down? You talk about AI.
It's going to go down by a quarter.
Everywhere in the business. Ford wanted to say, oh, we're protecting or creating 4,000 jobs. Well, yeah, but you're taking 600, about a little over 20%.
Almost
of the
25%
factory
of
jobs.
are going away. That's right. Look, I mean, that shows you how much more efficient this new assembly process is that you can bring more work into the plant, and they're bringing more work in. They're insourcing and still get rid of 25% of your workforce.
The other question that whole thing brought up to me, and I've had several people this week ask me, you've got a company, Ford, that can't get new products out the door without major quality problems. And yet they're saying this new process will be even better quality. And they're saying
That isn't hard though, is it? I mean, they just had a new recall for 312,000 vehicles for brakes.
Yeah.
Short answer, Paul, because we'll wrap this up. I believe Ford's quality problems are systemic to their legacy system. This new product is being developed outside of that completely, 100%. And so I think it has a much better chance. I'm not going to guarantee that the quality is going to be better. I'm sure they're going to have teething programs. This is a radical change.
Yeah. But
I believe Ford's problems are not from suppliers sending them shoddy parts. It's systemic. It's, I believe, due to the silos within the legacy organization, which does not exist at the Skunk Works. But we'll see. We'll see how it turns out.
Good.
Okay.
All right.
Paul, thanks for coming on. Gary,
you.
always good to see you. And thanks to all of you for having tuned in.
AutoLine After Hours is brought to you by